Welcome back to the Deep Dive. Today, we are cracking open the U-Haul Holding Company's Q2 fiscal year 2026 investor call.
Yeah, and this one was really interesting.
It was an intraday event, and it really presented one of the cleanest cases of, let's call it, financial tension we've seen this quarter.
It truly did. Because for anyone just, glancing at the headlines, the results look, frankly, disastrous.
Right.
But if you spend time in the weeds of the call, management's narrative suggests this is not a disaster, but deliberate, deep, short-term pain.
Pain that's required for a long-term structural transformation. So our mission today is to really understand that painful transition.
Let's do it.
So let's start with that immediate snapshot. The crucial metric for shareholders, GAAP-diluted earnings per share, or EPS, that's the legally reported profit. It came in at what, 49 cents?
49 cents. And the consensus on Wall Street was 87 cents.
Wow.
That is a staggering 44% miss.
44%.
And to put that in perspective, net earnings available to common shareholders were down about $81.2 million year over year. That's a 43% collapse in profitability.
So if you just stopped reading there, you would assume the company's core moving operations were just falling apart.
Absolutely. You'd think nobody was renting trucks.
But the data, it quickly tells a very different story about the core business strength. How did revenue and their main operational metric, adjusted EBITDA, look?
Well, see, that's the twist. Revenue was strong. It hit $1.72 billion. It was a narrow miss on consensus, sure, but it still represented year-over-year growth of nearly 4%.
Okay, so the top line is growing.
The top line is growing. And crucially, the operational metric they focus on, moving and storage adjusted EBITDA, it actually increased by 6%.
6%.
To $542.6 million. And this metric, it filters out non-cash expenses like depreciation, so it gives us a cleaner look at the day-to-day operations.
So, if the cash flow and the revenue are growing, yet net income is being cut nearly in half, the problem isn't the customer. It's not the pricing.
No.
The problem is entirely located in the cost structure. That sharp divergence between a record, $1.68 billion trailing 12-month adjusted EBITDA and the sinking GAAP earnings, that's the key takeaway here.
Exactly. And management pointed directly to a single culprit, fleet management costs.
Fleet management.
We are talking about an increase of approximately $107 million year over year in expenses, all tied to their truck and equipment fleet.
Okay, so let's unpack that. $107 million. That's the cost bulge. That is the dragon they are fighting right now. How did management break those costs down?
It broke down almost perfectly into two roughly equal halves.
Okay.
The first half, about $50.6 million, was higher rental equipment depreciation. This just means they're aggressively writing down the value of their newly purchased fleet. They're using an accounting technique to recognize the cost of those new assets much, much faster.
And the second half, the other $56 million or so, that came from what they called a swing in disposal results. That needs a clear explanation for you listening.
Right. It's basically the difference between selling a used car for a profit versus taking a huge loss on it. A year ago, the used vehicle market was hot.
I remember that.
And U-Haul was selling retired equipment, especially their cargo vans and pickups, for a gain. It was boosting their bottom line.
And now,
because the used vehicle resale market has softened drastically, they are booking significant losses on those exact same sales.
So that swing from a gain to a loss, that accounts for the other half of that $107 million hit.
That's the other half. And management stated this cost increase, this $107 million, accounted for nearly the entire EPS decline.
So it seems they are consciously taking the pain now to accelerate this whole fleet refresh cycle, which leads to the million-dollar question. When does this pain end? When does that depreciation dragon peak?
This is the critical piece of guidance for anyone analyzing U-Haul. And management was smart. They provided separate forecasts for their two different types of equipment because they use different accounting methods.
Let's start with the big ones, the large box trucks.
For the box trucks, they use what they call a dynamic depreciation model. It allows them to adjust based on usage and expected life. And they guided that the depreciation for this segment should peak relatively soon.
How soon?
Toward late fiscal year 2026 or early fiscal year 2027. But more importantly, they projected the normalized annual depreciation for the box truck fleet to settle around $700 to $750 million.
Wait, hold on. If the current run rate, including all these disposal losses, is hovering around $1.1 billion annually,
It is.
and they forecast normalization down to 750 million. We're talking about a potential savings and operating leverage swing of nearly $350 to $400 million annually.
That's it.
Once this trough is passed, that is immense.
That is the narrative management wants investors to focus on. They're saying, look, we spent 1.3 to 5 billion on new equipment in the first half of the year. We are at the tail end of this necessary investment cycle, and the savings are right around the corner.
But the cargo vans and pickups, the ones using straight-line depreciation, they're getting hammered by the weak used vehicle market. Can we trust that the trough is near for them, especially with used car prices still struggling?
That's fair. That skepticism is warranted. The chairman, Joe Shewan, he was slightly more cautious on this part. He stated that the combined impact of depreciation and disposal losses on the vans and pickups might peak about a year out.
So later than the box trucks.
A bit later. But the core message is the same. They are building a large, new, low-maintenance fleet, but they are paying for it, and paying for it heavily right now.
Okay, so while they are grinding through the financial fallout of the fleet refresh, they're clearly still executing on the long-term structural story. Let's pivot to the two main growth engines, self-storage and the dealer network.
The self-storage. This is the structural ballast of the company. In this quarter alone, they added 23 new locations.
23.
And 1.6 million net rentable square feet. This is how they're evolving into a hybrid operator and real estate play.
And the scale of that asset base is just staggering.
It really is. Their current owned footprint now stands at 71.2 million square feet. And they have another 14.2 million square feet, either in development or pending.
So this ongoing construction explains why capital expenditure remains so high, even as they take this big depreciation hit.
Exactly. They're spending on two fronts at once.
How did the existing storage facilities perform in the quarter?
Storage revenue grew approximately 10% year over year, which is very healthy. It was largely driven by average revenue per foot, increasing 4 to 5%.
So they have pricing power.
They do. However, there was a minor dip in occupancy. Same-store occupancy decreased 150 basis points to 90.5%.
That sounds like a potential softening in demand, especially given the competitive landscape.
It does, but management was proactive in clarifying that number. They said 220 basis points of that decline was a deliberate, system-wide effort to clear out delinquent tenants.
Ah, so they were cleaning house.
They view it as necessary portfolio maintenance, getting rid of non-paying customers to free up space for reliable tenants. It's good long-term hygiene, even if it hurts the immediate occupancy rate.
They also described the storage sector as a slugfest. What does that competition look like on the ground?
It's a battle over introductory pricing. Management noted that competitors often quote these really aggressive first-month rates, 30 to 50% below U-Haul's initial price, just to capture customers.
And then they hike the rates later.
Only to raise those rates steeply later on. U-Haul claims they avoid this strategy. They prefer a more transparent, predictable pricing model, which, while it might make the initial sale harder, they argue it fosters better long-term customer relationships.
Let's turn back to the core moving business. They have this massive new fleet coming online. To maximize the return on that investment, they need transaction volume. So how are they trying to drive utilization?
By driving distribution. They are aggressively expanding the dealer network. They've added nearly 1,000 dealer locations in the last 12 months alone.
1,000.
1,000. They've now surpassed 25,000 total locations. This is directly tied to that CapEx pain we talked about. You buy a huge fleet,
Yeah.
You need more places for people to actually rent it. They're trying to fill in every underpenetrated market they can find.
And when do they expect this massive geographical expansion to start showing up in the numbers?
Management expects to see, and I'm quoting here, visible numbers from this network expansion, meaning a measurable impact on utilization and volumes by June of next year.
We also need to talk about U-Box, which seems to be the bridge product between these two worlds.
That's exactly how they view it. U-Box operations contributed meaningfully to growth, and the company is explicitly positioning it as the seamless link between truck rental and storage. Their goal is to become the market leader in portable storage.
And the profitability is linked to filling them, just like regular storage.
Precisely. It's all about utilization, filling those containers and making sure they eventually end up in a U-Haul storage facility.
Finally, their outlook on the macro environment. What's the biggest headwind for moving volumes right now?
Well, they cited the depression in existing home sales. That was their word. It's the primary drag on DIY moving volumes. When people aren't buying and selling homes, they aren't renting trucks for big moves.
It makes sense.
The chairman also took a moment to address regulatory issues, specifically noting success in rolling back what he termed politically driven internal combustion engine regulations. He suggested this benefits the transportation sector overall and ensures they can continue operating their fleet efficiently.
Okay, so if we step back, the stock is down sharply over the last year. It's underperforming the benchmarks. What is the fundamental tension that you, as an investor, have to grapple with when looking at U-Haul right now?
It's the battle between short-term accounting pain and long-term asset value. The market is currently pricing U-Haul as a structurally challenged, cyclical company.
Just a truck rental business that's highly sensitive to housing cycle.
Right, and that's why it's underperforming.
But management is trying to convince us that that perception is wrong.
Precisely. Management is framing this depressed earnings period as the absolute necessary trough, the lowest point caused by simultaneously undertaking a massive fleet refresh and developing millions of square feet of storage. They argue the value of that self-storage real estate portfolio, plus the inevitable normalization of depreciation, is just dramatically underappreciated.
And that leads directly to the bullish analyst view.
Yes. The small analyst community covering U-Haul maintains a positive stance, and they're citing a median 12-month price target at around $96.
Which is substantial upside.
Huge upside. And their thesis is predicated entirely on that operating leverage, that $350 to $400 million swing we discussed coming into play once CapEx moderates and that depreciation bulge finally passes.
Now let's make the jump into our This Is Not Financial Advice's segment. We have record revenue, sinking earnings, and a cost peak expected in the next few quarters. This sets up a timing trade. What's an outrageous but plausible way to play this anticipated inflection point?
The thesis is simple. The market is behaving as if the current $1.1 billion cost run rate is permanent. It's ignoring the high probability that those costs will normalize down towards $750 million or less. So we want a trade that capitalizes on this anticipated shift in perception over the next, say, 18 months.
How do you structure that without sinking a ton of capital into a stock that still faces these near-term headwinds?
We use a synthetic long strategy with options to dramatically lower our effective cost basis.
Okay, break that down.
Think of it this way. We believe the stock will go up eventually, so we purchase UAL common shares. But at the same time, we sell an equivalent number of deep-in-the-money, long-dated put options. Let's use puts expiring in January 2027 with a low strike price as an example.
Why do that? Why sell a put option?
Because selling that put gives us a large cash premium right now. We are essentially selling a promise to buy the stock at a very low price in 2027 if the market collapses.
Ah.
That premium we receive from selling the deep put helps fund the purchase of the common shares. It establishes a long position at a significantly lower effective cost basis.
So you are basically hedging the risk of the next 3 quarters of earnings pain using derivative leverage.
Precisely. If management is right and the depreciation peak hits and the stock re-rates towards that $96 analyst target, this structure offers leveraged upside potential, and it minimizes the initial cash you need to sit through the rest of this earnings trough. It's a calculated bet on timing and management's forecast.
A sophisticated way to bet on the timing of a cyclical recovery.
It is, provided you believe the structural assets are worth more than the current operating pain suggests.
So to recap the Q2 call highlights, U-Haul is undergoing a massive, painful transition toward a hybrid operator and real estate model. The Q2 print validated the enormous cost of that transition, the $107 million cost bulge, but it also validated the scale of the platform being built. Over 25,000 dealer locations and 71 million square feet of owned storage.
They are building for the next decade, and the market is still focused on the cost of the last 2 quarters.
And remember, that preceding segment was for entertainment only and is not financial advice. But here's the final provocative thought for you. Management cited slowing self-storage supply expected in 2026, meaning less new competition. If the current capital expenditure cycle positions U-Haul with a huge modern fleet, just as those massive depreciation costs normalize and housing transaction volume finally recovers, is the market wildly underestimating the magnitude of the operating leverage coming in fiscal year 2027 and beyond? That $400 million in potential cost savings is what you should be watching over the next few prints.
That potential future cash flow is the key to the entire thesis.
Thanks for diving in with us. We'll see you next time.